So we've just reviewed this lower cost or market analysis out that it really only goes one way and not when costs are increasing. But that isn't uniformly true. There are instances where we would write up our inventory. But that's going to only occur with specific types of products, commodities, specifically oil and gas or mining. So while it might be tempting to value inventory above cost for other kinds of things, GAAP doesn't permit it except in limited instances. And this is an example. And I'm going to just skip over. Sometimes, for whatever reason, we are unable to go out and take a physical count of our inventory. And therefore, we need to do estimates when we have financial statements that we have to prepare and are not in a position to go out and take that physical count. And so we can do some estimating about what our financial statements are. What our inventory values are, but this is only possible to do with interim financial statements. So if we have to prepare them monthly or quarterly, it may not be feasible or practical to go out and do a physical inventory that often. So companies will often estimate. If you do this estimate during the year on financial statements, then when you do your annual financial statement and you actually go out and count, you have to reconcile the inventory values that you had given on the interim financial statement from the estimates with the actual inventory counts for the annual financial statements. So in order to accurately estimate, there is an assumption that the gross profits are going to be consistent when we're using the gross profit method. So there are two methods we're going to talk about. This is gross profit. We'll talk about retail in a minute. But under the gross profit method, it assumes that profits are going to be level from prior periods because we're going to use the prior period profit figures to make some assumptions about the current inventory. And so if our current profits are not consistent with the historical profit numbers that we're using, then these estimates are not going to be accurate. First, we need to calculate a ratio based on our historical gross profit figures. And that's going to be the gross profit from prior periods, whatever we choose that's a prior period that is appropriate, to the net sales from prior periods. And we will come up with a percentage. Next, we then need to calculate what goods we had available for sale in our current period. And we do that by taking our beginning inventory and adding our net purchases for the period to that figure. Sorry, more interruptions. Okay, so we then have to estimate our gross profit for the current period. So we take the historical gross profit rate, this percentage that we calculated in step one, and we multiply that times the net sales revenue for the current period. Now we're going to do an estimate for our cost of goods sold for the period. So we'll take the net sales revenue for the period and we'll subtract our estimated gross profit that we calculated up here in step 3. And then we'll determine the cost of our estimated cost of ending inventory as the cost of our goods available for sale minus the estimated cost of goods sold. And so we'll see the example here with the Hardin Company. And so we see that they have net sales for the period of $130,000. They have their beginning inventory. They have their net purchases for the period, and they're just giving us the historical gross profit rate. So we're not actually going to calculate the historical gross profits from the prior periods. So we start with this premise of a 40% gross profit rate. We get our goods available for sale. So we started with 10,000, we bought 90,000, so that gives us 100,000 in goods available for sale. Now we're going to estimate our cost of goods sold. And so we've got a two-step process here. First, we take our net sales for the period, which they give us up here, and we multiply that times the historical gross profit rate of 40% to come up with our estimated gross profit. We then take our sales for the period and our estimated subtract our estimated gross profit to come up with our estimated cost of goods sold for the period. We subtract that from the goods that we had available to sell, and that gives us an estimated ending inventory of $22,000. So there are this can be useful, but there's some adjustments that we need to make. If, for example, we know that there is a disconnect between the gross profit and net sales, we should make that adjustment if we've not, if we've made some changes that might not result in that being accurate. If we have different profit margins for each of our products, as opposed to, in this prior example, we calculated it based on our entire inventory. But if we've got a different markup for each individual product, then we've got to make some adjustments based on that. And so, yeah, if we've got fluctuations, we're going to have to make sure that we take those into consideration. And now we'll move on to the inventory method of estimation. So this is an alternative to the gross profit method and relies on the retail price, which is basically what we would sell it to the public for when we're looking at values. And so this has a couple of advantages. It's going to give us a pretty good estimate of what we're going to be able to sell this for at the retail cost, or not retail cost, retail price, I should say. And another advantage is that we can use this retail estimation method not only for our interim financial statements, but the IRS allows us to use it for income tax purposes, so that we don't have to separately go out and take a physical count if our tax returns are due at a different time than our financial statement, if our tax period and our financial reporting periods for some reason don't sync up. So, using the retail method, there's certain information that we need to maintain. We still have to keep track of our inventory at cost, but we also need to track it at retail. Same thing with the things that we buy. We've got to maintain numbers of what we paid for it, as well as what we're selling it for. And then if we have any changes in our retail value as a result of markups or markdowns, and then we obviously need to track our sales. So, step one, we compute the goods available for sale just like we did under the gross profit method, but here we're going to have to do it under both the cost and the retail value. Then we're going to determine the ratio between the cost and the retail value, and then compute our ending inventory at the retail. So we'll have our retail value of goods available for sale times our net sales revenue, and then we'll compute our ending inventory at cost. And here's an example of that method. So we've got our beginning inventory at cost and retail, purchases at cost and at retail, And then we have our sales figures at retail, obviously not at cost because we don't have retail cost sales. Then we need to calculate the ratio of our goods available for sale between the cost and the retail values. So we have a cost of goods available for sale at $60,000 and a retail value at $100,000, and that gets us a 60% ratio. Then at retail, we calculate what our ending inventory is, and then we multiply that ending inventory by the ratio, and then that gives us our estimated ending inventory at cost. And so here's just some retail jargon for your viewing pleasure. I won't go through each of these individually, but you can pause the video and take a look at these. So depending on the inventory method that we use, to establish our cost assumptions, we're going to make some modifications, I guess, or assumptions, I should say, to facilitate the retail inventory method. So if we're using the FIFO method, we'll exclude cost and retail value at the beginning inventory, but the ratio should include both net markups and net markdowns. And there's actually a chart on the next page which probably more succinctly describes what I'm talking about here. So in application of the retail method, you see that under FIFO, beginning inventories excluded, mainly because we assume that we've gotten rid of it. And then purchases, we include net markups, net markdowns. Under the average cost method, we would include everything because the average would be based on everything. And then LIFO, similarly, beginning inventories excluded. And then under lower of average cost or market, we would exclude net markdowns. So here we've got Thompson Company, and their beginning inventory is $20. We'll just say at cost, and at retail it's $40. They buy $40 at cost, and at retail that would be valued at $80. We exclude the net markups, net markdowns, although we include those in the retail calculation, and we get to our goods available for sale of $60 at cost, $115 at retail. Our sales, then, we subtract from that to get our ending inventory at retail of $49. Now, under the FIFO method, we're going to come up with a cost to retail ratio that excludes our beginning purchases. Our beginning inventory. And we're only going to look at the purchases in terms of when we had looked before at cost available or goods available for sale, we're going to exclude the beginning inventory under FIFO because we're going to assume that we sold that first, so it's gone. And we will only look at the ratio for our purchases, including the markups and markdowns. So we have a ratio of $40 to $75, and that gets us a percentage of 0.5333, which we will then multiply by our ending retail inventory figure to come up with our ending inventory at FIFO, and therefore our cost of goods sold, which we would subtract our ending inventory at FIFO from our ending inventory at retail to come up with our cost of goods sold at FIFO. Under the average cost method, we do include our beginning inventory. And so we're looking at goods available for sale and computing that ratio to come up with 0.5217 as the cost to retail ratio. And then we multiply that number times our ending inventory at retail to come up with our ending inventory at the average cost and our cost of goods sold at the average cost. Now, under the LIFO method, we've got a bit of a two-step process here. So we've got our beginning inventory that we're going to calculate one ratio for cost to retail. Then we've got our purchases versus our retail purchases at cost versus our purchases at retail, including markups, markdowns, and we get a separate ratio for those. So we have these two ratios, and now what do we do with them? Under the prior methods we've talked about, we would have just had one ratio. We took that ratio, we applied it toward our ending inventory at retail, boom, done. Not so simple under the LIFO method. Under the LIFO method, we need to break it up into layers. And so we've got the ending inventory at retail that's comprised of $49. And if you think about it conceptually, under LIFO, last in, first out, the stuff that we sold last, or the stuff, excuse me, that we purchased last was gone first. So the stuff that we started with, we still have. So of the $49 of inventory value that we have left, under LIFO, 40 of that came from our beginning inventory, and then 9 of it came from the additional purchases. So now we need to allocate the two ratios to the two LIFO layers. So we first use the $40 of beginning inventory, and we multiply the ratio, the cost to retail ratio, we came up for that figure, and that gives us $20. We then look at the 9 remaining dollars of inventory value that are left from the purchases, and we calculate that at the purchases ratio that we came up with. We then add those together, and that gives us our ending inventory at LIFO. Then, if we subtract this from our goods available for sale at LIFO, that gives us our cost of goods sold. Yay. Now, if that wasn't enough fun, we can use the retail method to calculate the lower of average cost or market. And this will differ slightly from the calculation that we did when we just looked at the average cost or market. I'm going to just skip back really quickly. So imprint this in your minds for a second about what we included to come up with the cost to retail ratio under the average cost method. Now, we're going to do it under the lower of average cost or market method. And so what we've done here is we've calculated a ratio, but we've done it before we got to our net markdowns. So the ratio is based on, it's still the same on the cost side, but under the retail side, it only includes net markups and then it stops to calculate the ratio. The goods available for sale still include the net markdowns at retail. And so thus we still end up with the same ending inventory figure at retail. This just gives us a different ratio that doesn't take into account the net markdowns. And so then we calculate the ratio times the ending inventory at retail as we have done previously. We come up with $23.52 for our ending inventory at lower of cost or market. Subtract that from our goods available for sale at cost, and that gives us a cost of goods sold of $36.48. Now, sometimes we've got to make some additional adjustments under the retail method, because you may also have considerations such as freight charges, purchase discounts, purchase returns and allowances, normal inventory shrinkage, abnormal inventory shrinkage. Probably a Seinfeld episode. Anyway, and employee discounts. So there are some assumptions that lie within the retail inventory method that if they are not true, you're not going to have accurate estimates for your estimates using the retail inventory method. And so basically we're relying on the fact that a company's inventory is basically going to be very similar with similar markups, markdowns, and that the cost to retail ratio is going to be constant over the accounting period. If that's not true, then this method is not going to produce a reliable figure. And here's an example of a financial statement with notes that discusses that. And we'll skip over. You're free to stop these slides and read about Walmart. And I'm going to stop here and go on to the next video for the dollar value retail method.